Hello and welcome to Newscentre. I'm Parikshit Luthra. Pharma companies have largely reported strong earnings and the healthcare sector is abuzz with M&A activity. Shares of Cipla hit a record high in trade today after a CNBC-TV18 report suggested that promoters of the company are looking to offload part of their stake. Sources have told CNBC-TV18 that Blackstone and Baring Asia are likely to be interested. Nisha Poddar joins us now with the very latest. Nisha, what does this mean for the company?
That's right. 3 independent sources with direct knowledge of the developments of Cipla have shared with CNBC-TV18 that the promoters of the company are open and exploring the option of part stake sale in the company. Remember, they own about 33.5% stake in Cipla, and we hear that they are in talks with several private equity players for exploring a transaction and stake sale to get them on board. Now, we do gather that Blackstone as well as Baring Asia, amongst other private equity players, could be more inclined in exploring a transaction at Cipla. Now, here they are trying to solve for 2 important aspects, the promoters. First of all, succession planning has been one question that all the investors and experts have always asked this company, given that their second generation of the promoter group are octogenarians now, still active, but on the other hand, the third generation has little involvement. Only one of the third generation promoter family participants is part of the company. So succession planning is critical, and on the other hand, private equity has been interested in this particular space, and they coming on board could also revamp the strategy and also improve the performance matrices. We did reach out to all the parties named in this particular story, and we didn't get any response from any of them. Of course, Cipla has issued a clarification to the stock exchanges on our news break. But a stake sale by the Cipla promoters is what is being explored.
And shares of Cipla were rallying in trade even before the CNBC-TV18 news break after the company reported strong first quarter earnings. Ekta Batra is here with more on what's really driving the pharma rally and why there is rise in M&A interest across promoter-driven companies.
Pharma stocks have started Q1 on a good note, along with possibilities of M&A, which has fired up sentiment today. Let's start with the earnings. Pharma majors Cipla and Dr. Reddy's both reported a top-down beat yesterday. Syngene, Biocon's research arm, also saw revenues grow 25% year-on-year. Focusing on the 2 large generic drug manufacturers, Cipla and Dr. Reddy's, a key theme that played out for them was the US doing better than expectations, aided by contribution from key drug Revlimid generic, used for cancer. The other factor that has fired up a lot of the pharma stocks is the growing private equity interest in the sector, with the latest trigger being the story broken by CNBC-TV18 that private equity investors may be keen to pick up a slice of the promoter stake in Cipla. While the promoters of Cipla have not responded to CNBC-TV18, Cipla has informed the exchanges that it has nothing material to disclose to investors. In fact, we have seen a significant amount of M&A in the pharmaceutical space, with some examples being Fosun Pharma buying Gland Pharma for over $1 billion in 2017, KKR picking up a controlling stake in JB Chemicals. The stock has soared around 225% since the deal. Carlyle bought 20% stake in Piramal Pharma for more than 3,500 odd crores. Unichem Promoters also sold controlling stake to Ipca Labs. The heightened interest has put the spotlight on several promoter-driven companies in the pharmaceutical space where there are no clear succession plans in place. Lastly, while there may be headwinds such as sustainable growth drivers, ex of Revlimid generic, tepid growth in India for the likes of Dr. Reddy's, it's been a great year for many pharma companies. We leave you with the current valuation picture.
All right, thanks very much, Ekta, for explaining us all the M&A activity in the pharma space. We're now joined by Aditya Khemka, fund manager at IncredAmc. Aditya, thank you so much for joining us here on CNBC-TV18. Let me begin by asking you about the M&A activity we could see in 2023. We've been seeing an increase in M&A activity over the last few years. In 2022, there were 16 large deals, and the deal value was close to $6.14 billion. How do you see the M&A activity in the pharma and healthcare space this year?
So, hi, thanks for having me. So I feel you will see more M&A activity in the branded generic space. It's a space which most pharma companies have come to realize is high ROE, high margin business, and it is difficult to scale up organically in that space. It is much easier to scale up inorganically. So, companies that focus more on India are likely to see more interest in terms of acquisitions, stake sales from their peers, etc. And I think that's one space you will see a lot of M&A activity happening. The other two spaces where I feel in M&A space could be hot would be hospitals. Again, same reason, hospitals are branded franchisees. And again, a newly built hospital takes about 3 to 4 years to break even. It takes a year or two to construct. So inorganic is basically shortens the time frame there as well. We also might see some inorganic activity happening in diagnostics. Again, same reason, branded franchise, asset-light model, high margin business, and difficult to scale it up organically. So I think all these three spaces, we are very likely to see heightened M&A activity in the next few quarters and few years.
Aditya, last year we had seen a lot of domestic companies showing a lot of interest and also wanting to buy subsidiaries of large MNCs as well. Do you see that continuing this year as well, or you feel there will be more PE activity?
See, strategic always makes more sense because there is more synergy that a strategic player can derive versus a PE player where the level of synergy cannot be that high. Whereas a PE can bring professional management. In a strategic, you may not have a professional management. You still may continue to be a family-run business. So both sort of deals have their own merits. But I feel that the way the landscape is today, you'll probably see more strategic happening in the branded franchisees and maybe more PE happening in the more unbranded commodity manufacturing space. The simple reason for that is that wherever companies are owned by families and the families want to scale up the business, it is easier to go the inorganic route. They already have a lot of cash flow from their branded franchise and that cash flow can be used. But in the unbranded space, very few companies currently are promoted by the family. But wherever, even if so, the fact is that these families want some PEs to come and work with them and help them grow the business because the business has already attained a scale beyond which it becomes difficult to grow. So which is where I feel that in the unbranded space, you might see some PE or strategic, but in the branded space, you will see more strategic than PE is what my sense is.
Right. Now, as Nisha and Ekta have been reporting that Cipla Promoters are exploring a stake sale, how is this important for the company? It has been reported by them that this is also a part of succession planning exercise. What makes Cipla a lucrative option for PE investors?
So first of all, we don't know whether this is true or not. This is just a story which has been broken and the company hasn't confirmed it. But if they were to sell it, I mean, if you go back in history, I think March 22 or March 21, I think March 21, the promoters of Cipla had sold about 3% stake in the company. At that point in time, the rationale given was that they wanted to get some cash flow to do some philanthropic work. This time around, it could be a similar rationale if at all it happens. Or even if PE firms were to come and take it, the idea is that, again, the PE firms can bring some more professionalism into the management and maybe help the business scale up a little faster than what the promoter family has been able to do thus far. I mean, that's the only thing that I can think of at this point in time.
Right. As far as the domestic policies, the Indian government policies, which can really boost and drive M&A activity in the Indian pharma sector, there have been PLI schemes. More PLI schemes are being considered. In this parliament session, we're expecting the new drugs, medical devices and cosmetics bill, which could be passed in the parliament as well. How could these policy changes drive M&A activity according to you?
So the government policies are extremely important for a sector as regulated as healthcare. And any conducive policies will obviously improve the potential earnings and the potential scale of these companies. And, PLI was a small step in the right direction, in my view. And PLI came only in a couple of pockets, which is API and a few formulations. But a larger PLI scheme or a larger incentive structure like that could obviously help the industry to scale up much faster. India is already considered as the pharmacy of the world. So we do have a strategic advantage compared to the rest of the world. And with a little bit of government incentive, it can obviously become better and it can become more dominant globally. And if so, then again, the interest of PE players and interest of strategic buyers would again increase because with conducive policies, they can also see more upside into their investments than they would have seen otherwise.
Right. Within the pharmaceutical industry, do you feel there are any particular sectors which would be of particular interest to PE players or domestic companies or international companies?
So I feel on two fronts, you'll probably see a lot of interest. One is obviously the branded franchisees, so which includes your branded generic markets like India. So companies which are predominantly in India as a source of business. Number two, hospitals. Number three, diagnostics. So I put them all in one umbrella called branded franchisees. And on the second hand, you can probably see some interest in manufacturing. But within manufacturing, I think interest will be slightly more on the raw material API intermediate side rather than the unbranded US generic or European generic side, simply because global companies want to backward integrate. They want to have a secure supply chain, China plus one, and there a strategic investment in some of these API manufacturers in India would help them achieve that goal much faster, and with a more sort of strategic play in the backward integration rather than just outsourcing it. So I think these are the two pockets where I feel there'll be majority interest. And yeah, we will see how the ball rolls.
Right. Aditya Khemka, thank you so much for joining us, explaining us the reasons behind M&A activity in the Indian pharma sector and what are the potential government policies which could drive this growth further. We're heading to a short break here on Newscentre, but up next we speak to Samsung India's head, Raju Pullan, on the company's latest offerings. Ashmit Kumar, my colleague, will get you a special report when we return. Also, a special report on electric vehicles and charging infrastructure.